risk management, everyone's favorite topic to ignore. Here we go. I'm actually being quite serious. If I held a seminar and called it Best Risk Management Techniques for Traders, maybe about 10 people would show. But if I held a webinar called Fibonacci Secrets, it'd be standing room only. Isn't that interesting? People want the glitter. They want the shiny stuff. But the important parts of trading is this. It's the risk management. This is what will keep you in the game. You want longevity in this career? This is the topic for you. Let's dig deep. This is arguably the most important factor in trading, risk management, and for very good reason. Without it, you'll blow out your account. That's it. Game over. Done. Proper risk management will keep you in the trading game. It gives you a chance to learn the skill of trading with good risk management. Without good risk management, it's only a matter of time before it's a game over scenario. And you don't have that luxury as a trader. You need that time to learn how to trade. And to get the time, you have to manage your risk. Without solid risk management, it's only a matter of time before you lose either a very large amount of your funds or blow out all the entire account completely. So we have to protect ourselves. When it comes to risk management, there's really two primary technical factors involved: stop loss and position size. I say technical because really great risk management starts here. It starts with your thought habits. It starts with deciding you will use great risk management. That's where it starts. The technical stuff is the stop loss and position size. Let's look at that. Both are mandatory to a successful career in trading and to be able to manage your risk properly. So the blue line, buy to open, that's our entry. The red line, sell to close, that's our protective stop. As a trader, you need to have strict rules in place for each trade. So here's some examples to choose from. Number one, I will always place my stop blank points below support or above resistance. Now points, that could be pips if you're trading Forex, ticks if you're trading futures, points or dollars or cents if you're trading stocks, options, things like that. So it depends on what you trade, but the principle stays the same. Place your stop at a certain level, either above or below support and resistance there. Number two, I will always place my stop blank percent below support or above resistance. So you could be a dollar amount or a percentage amount. That's up to you. Next, I will always position size my trades at blank percent of my account. Position sizing is critical. It's one of the most important elements in risk management. And many people have no clue how to do it. So I'm not going to assume that you know how to do this, even though you're experienced traders in taking this course here, okay? If you've never position size or don't know how to do it, I'm going to walk you through it right now. Basically is this. I will always position size every trade I take to ensure maximum profit potential without going over my allowable loss limit. So there's two factors involved in this sentence here that are very important. Number one, maximum profit potential. And we don't want to go over our allowable loss limit. Okay, so we need to decide what that allowable loss limit is. Each one of us needs to have a limit that we say, enough's enough. I'm not risking any more than whatever that amount is. Let me show you an example. Let's say we have an account size of $50,000 and we are allowing or comfortable with risking 1% of that per trade. So that's $500. Okay, so that's really the first part of this is what's our account size? How much are we willing to risk per trade of that account? In this case, 1% or $500. Now, in this chart example that you see down there, the blue line is our entry. So we have an entry price of $89.49. That's the entry price. So we got support down there. We're going to buy at support. Okay, just simple example here. Our stop loss is going to be at $86.34. That's the red line. Now, the distance from entry to stop, that's $3.15. $3.15. So that's the distance. So that means our maximum position size will be 158 shares. We will not be allowed to trade more than 158 shares. Why? Because if we did and got stopped out, we would be losing more than our allowable $500 or 1%. Here's how. To calculate your Hold on a minute. I said calculate. Sorry, for all of you that are allergic to mathematics, I apologize ahead of time. But every trader needs to have some very basic understanding of math when it comes to trading. So get your Benadryl and let's get to work. Here's the calculation. You're going to take your dollar risk per trade. You're going to divide that by your entry to stop distance. And that will give you your maximum allowable shares. We don't trade any more than that. We can trade less, that's fine. We can always trade less, but not more. So in the example above, it looked like this. Dollar risk per trade, we were risking $500 in that previous chart example. The entry to stop distance was $3.15. So that means we can allow ourselves up to 158 shares. So if we bought that stock at the entry price with 158 shares and we got stopped out, what does that mean? It means we'd lose $500 or less because we position sized to lose no more than the $500. But if we trade more than 158 shares, let's say 170 shares, and if we get stopped out then, we'd lose more than our allowable risk amount. This is simple math and it's critical for every trader to do. Let's dig a little bit deeper here. I've created a matrix for you to understand this better. Let's first start off with anything greater than 2% risk per trade. So that means 2% of your total account would be used as risk on the trade. So that would be considered on the very aggressive side. Your risk tolerance would certainly have to be very high. So in the example given here, we have a $10,000 account size. So that would mean that your risk per trade would be over $200. 2% would be exactly $200 per trade. Next up, aggressive but not very aggressive would be 1.75 to 2% per trade. Moderate risk would be anywhere in the range of 1 to 1.5% risk per trade. So that's $100 up to $150. And a little more on the cautious side would be 0.5% up to 0.75. Something too cautious would be pretty much from a little above 0 to 0.25%. The reason why I say too cautious is because you're really not going to make any money on that. It's just too low of a risk per trade to get any, quote, bang for the buck. All right, so there we are. There is your matrix. So give it some thought here and consideration in your own trading. Now, there's several factors involved in this, of course. Your skill level has a lot to do with it. In fact, remember this, write this down. The lower your skill is, the lower your risk should be. The higher your skill is, the higher your risk may be, up to 2%. Okay? So if you're wondering, well, what should I risk? Where should I start? Start low. Ask yourself, what's my skill? If my skill is low, then there's your answer. Start in low to medium. If your skill is high, then you can go all the way up to your 2%. That's up to you. Every trader needs to decide where their own risk tolerance is. But this graph here just gives you a kind of a basic example of what some of the different levels of risk tolerance would look like. All right, so let's look at a chart example. There's a lot of trade technology out there to make our life easier. What you're looking at here is a chart of the TradingView platform. The blue line represents the entry to buy, so buy to open. The sell to close is the red line. And then we have a sell to close for a profit target up there higher. Now the buy to open, it tells us the open P&L, the quantity, there's our 158 shares right there, risk to reward ratio. The stop tells us the stop percentage, the amount, how much money it's going to take to actually place this trade, which is $49,500. So we need to think about that as well. If we only have a $50,000 account, well, we're pretty well maxing that out then, aren't we? Because it's going to take $49,500 just to place this trade. Because 158 shares times the entry price of $89.49, that's going to cost $49,500. So again, if we have a $50,000 account, okay, fine, we can take that trade. But if we have maybe a $20,000 account, we're not going to be able to take that trade. So that's why we have to drop our shares down to meet the actual account size requirement. All right, let's take a look at your action steps. Decide what location you will place your protective stop loss. Where specifically will you place it? Number 2, decide how you will position size your trade. What percentage of your account will you risk per trade? I'll remember, You can always change your answers later as you learn more, as your skill increases, but right now it's very important you decide and create a habit of great risk management. All right, once you've done that, you can go ahead and continue on to the next lesson.